There's a big update that has come in for Swiggy. They will be exiting completely from Rapido, and they will be selling their stake to Prosus and Westbridge affiliates. Now, this entire deal is happening at a cash value of close to 2,400 crore rupees, and this amount at which the deal is happening is lower than what media reports were earlier, which valued the company's stake at close to 2,900 crore rupees. Now, the stake sale announcement is pretty much in line with what the management commentary had come in during the first quarter call, where they had clearly mentioned that they will be selling their stake, they will be monetizing their stake in Rapido for some cash. And the stake sale, if you look at, boosts the cash value on books of Swiggy by around 45%. But given the average cash burn that we are seeing for the last couple of quarters, which stands at close to 1,030 crore rupees, this increased cash balance of 7,750 crore rupees will be sufficient for the company only for the next 8 quarters, which is including the second quarter of FY26. Now, this cash balance of 7,750 is less than half of what Eternal, which is Swiggy's direct peer, has. Eternal's cash balance stands at close to 18,860 crore rupees. Now, why Swiggy is seeing such a high cash burn when compared to Eternal? Firstly, they are foraying into non-core businesses. They have launched multiple apps and multiple investments they have been doing in apps like Toying, Giftables, Swiggy Scenes, Ping and Snack. Apart from that, the food, there has been a massive market share loss in the last 1 year when it comes to the food delivery business, and also when it comes to quick commerce, their losses have been widening. And because of all these three factors, the cash burn for Swiggy has been much higher at more than 1,000 odd crore rupees. And why this depleting cash flow is a big risk that could come in for Swiggy going forward, because their expansion plans could come at risk, and given at a time when new players are entering the quick commerce market like Amazon Now and Flipkart Minutes as well. Now, Swiggy is planning to add just 40 to 50 stores per quarter going forward, while in front of that, Swiggy is adding nearly 200 to 250 stores per quarter going forward. So clear divergence you can see on the store addition front, which could lead to more market share loss for Swiggy going forward. Now, Morgan Stanley is of the view that this stake sale will temporarily strengthen the balance sheet, and companies, however, even after strengthening the balance sheet, companies' cash balance remains weak when compared to competition. And given the intense competition environment that we have been currently seeing, they are not ruling out a further fundraise or stake dilution that could happen from in Swiggy. Separately, there's another news that has come in. Now, Swiggy will also be transferring the quick commerce business to a wholly owned step-down subsidiary. Now, why they are doing so? As per the company, this proposed transfer would help them create a more efficient and a proper structure. But what could happen going forward? Now, this holding companies type structure that we are seeing could enable the company for value unlocking. Apart from that, this could also lead to separate fundraise, specifically in the quick commerce business, where we are seeing more cash burn coming in. And lastly, as per Nomura, this restructuring is a step in a direction which will enable Instamart to own its own inventory in the quick commerce business once Swiggy becomes an Indian owned and controlled company. And this will happen when the domestic shareholding in Swiggy will cross over 51%, and this will help Swiggy to own its own inventory, and this could also increase the margins by around 100 basis points is what Eternal had guided earlier. So this could be a positive move coming in for Swiggy at this moment.